All right, guys. Thanks for joining the Thursday session. So again, every Thursday, 4 o'clock Central, we have our training on either sales ideas or products or a mixture of both. Wednesday nights, if you didn't know, we do training Wednesday nights too. It's called Back to Basics, and the idea is to talk about all the remedial stuff, whether it's illustrations, case design. We actually did a little fun event last night. It was reviewing homework. So we had a case design that we shared with people. They all went and did their own illustrations, and we just compared them. And then I went through some of the methodology that I think about when I do it. So again, it's all about getting better, just thinking outside of the box because, being in this industry for 18 plus years, not one client has ever been the same. So we always want to make sure that we are thinking of different avenues and ways to help clients. As I've always said, we want to do good for our clients, and as we do good for our clients, they'll do good for us. And so today, the topic being tax advantage products like life insurance as an asset. Really, what we want to make sure we get out of this is how can we truly understand life insurance being an asset? So that's always a question. We want to talk and learn about some of the tax benefits of permanent life insurance, and then really review some life cases. We'll say real life. I'll just say examples of how to kind of perceive the product and the process. And ultimately, we want to think about first and foremost why life insurance is actually an asset class. And why does that matter? Because if you think about it, a lot of people will perceive it as a bill. Oh, geez, my premium is due, whether monthly, annually, whatever it may be. A lot of people find it as a burden because their money is going to something that they can't, play with. So, I mean, cell phone is a great example. Everyone loves to play on their cell phone and things like that because it's tangible. You can touch it. Now, the difference is, though, with life insurance being an asset class, people still don't perceive it that way because they can't touch it, feel it, play with it. Retirement assets are the same. You can't really touch it, feel it, play with it, but you can see the market, and if it goes up, you see your money go up, and everyone likes the excitement of that. So, how can we perceive life insurance as an asset class if everyone perceives it as a bill? Well, first off, we have to think about the benefits and reasons why people utilize this type of product. So, life insurance provides tax deferred growth and tax free benefits. Right off the bat, those are very advantageous things that not a lot of people think about. And we also have to perceive it from two sides of the fence. A lot of us like to think about life insurance from the standpoint of tax free income, cash value growth, benefit of your money growing. And I hate to say it, but a lot of times you could easily get outpaced by market performance. A lot of people think of it as this thing to outpace the stock market, outpace your 401ks. It's not designed to do that. It's designed to complement that. So, but we have to look at the true abundant value of it. There's an abundant value of cash value growth, and there's also a value of that death benefit. And people have to see the holistic total picture. They can't just take one piece of it and negate the rest of it because there are fees attached to insurance, which are a piece of that as well, that you can't also negate. You have to kind of have that explanation with the consumer. So when you think about it, it can be help from the wealth protection side. So we talk about like the actual death benefit. How does that preserve assets and reduce the tax burden? Liquidity access, so cash value, can be leveraged for financial planning. It can be part of evaluations for businesses. It can be part of, a retirement plan. And estate planning, really, in regards to transferring wealth, nothing is better than shifting your risk for pennies on the dollar to an insurance company. Now, not a lot of people will say it that way, but if you think about it, you're paying someone else to take on that risk. And you're not giving them a dollar for dollar, you're giving them a quarter for them to take a dollar of risk protection. So it's leveraging that conversation and how you position it that makes all the sense in the world. So, as we kind of mentioned before, there's situations here where we talk about tax-free death benefit. Beneficiaries receive proceeds tax-free, and you have tax-deferred growth, that cash accumulation. But really, it always boils down to assessing the client's goals. So, what I always say to people here is, does the client want, DB, or do they want income? And that's the biggest question that you're always going to run into when you talk to your clients. Because as I said already, I'll say again, 18 years of doing this, not one client has been the same. So when we think about it in regards to our case studies and how we look at these from a profiling perspective, we'll first look at the one that everyone really loves talking about. We talk about retirement income planning. So, how can our clients have a way to provide a tax efficient income stream during their retirement? Well, obviously, we in the insurance industry love talking about utilizing life insurance cash value for those tax favored, you could say tax free, but I always like to say tax favored because if people take all the money, there's taxes. So we say tax favored loans and withdrawals to provide supplemental income. And that's the word I really, really, really want to highlight here is it's supplemental. We want it to complement, and a lot of times you'll see people do the three buckets, tax now, tax later, tax never. But they always want to talk solely about this because that's all they can sell. Now, if strategically planned appropriately, we can help them with all three buckets with different solutions. But for reference sake, for this example, for this, presentation, we are talking about that tax never vehicle through loans and withdrawals to give a supplemental income plan. The benefit for this, it does increase someone's financial security. It also reduces tax liability. So if someone pulled out 100,000 from, say, a 401k, or they pulled out 50,000 from a 401k and 50,000 from a LIRP, a life insurance retirement plan, they're ultimately paying less taxes per year because one is tax-free and one is tax later, but you still are balancing out your portfolios to give a proper reduction as opposed to just taking and bleeding one dry. Does that make sense? Anything, I'm saying incorrect? If you have a question, feel free to do the little raise hand, or I have another monitor over here that I'm monitoring that has the chats. So if you have any questions that you want to ask, feel free to put them in the chat as well. Okay. So I don't want to break the flow, but if there's the ability where you guys have questions, you could either raise a little hand or you could put it in the chat. So yeah. So again, just kind of restating the fact here, retirement income opportunities. We talk about LIRPs, life insurance retirement plans. Some people call them SERPs, supplemental executive retirement plans. Okay, so they can be called several things. Some people will call it by the tax code, which is 7702 plans. So people like that because it sounds a little bit more official, I guess you could say. But we want to take a look at a design here and how we would really strategically position this. So if you'll notice here, in the first year, we are putting 40,000, oops, sorry. We are putting $40,000 or $20,000 away per year. Matter of fact, we do that for a total of 20 years. Now, in the strategy, we have to once again remember there are three benefits to this solution. If I die too soon, I have the death benefit. If I get sick along the way, this carrier gives you half of the DB in a chronic illness rider, up to 500K. So you can get half of that if you get sick along the way, you can't perform 2 out of 6 activities of daily living, or if you make it to retirement of your dream, now you have tax favored or tax free income that you're going to start pulling out per year or per month, whatever. But they're showing the annualized returns. So in this strategy, I did a 20 pay where you'll see we put in a total of 400K. And in the first 5 years, you get all your principal back. Well, this is a 25-year withdrawal, so the total amount pulled out is $2.1 million. Okay. So when you think in larger terms, a client has put in 400K total for over 20 years, and they've pulled out $2.1 million. So the leverage is great, but a lot of people are going to hear that, think it's awesome, buy it, and then at the end of the first year, they're going to say, Phil, the market was great. Why is my money less than what I put in? So once again, going back to that asset class, this is a self-completing policy. If you die along the way, insurance costs money. If you get sick along the way, insurance costs money. But if we can have an educated conversation around, say, the internal rate of return, which we can always dive into on another call, it's a pretty interesting way to sell this type of solution. You can even use it for death benefit sales. But, is the cost of tax greater than or equal to the cost of insurance? Now, what you'll see here, and what I tell people all the time is these type of plans, if you're talking to parents, they get it a lot easier than, say, some people who don't have kids. But a lot of times when you're doing a LERP plan, it's almost like you're raising a kid. Okay? So when you have an infant, you're doing all the work. You're feeding it, you're changing it, you're putting it to sleep, you're doing everything to take care of that child. There's not a lot of reciprocation in the beginning. So what I tell people is that usually by around the 10th year or so, you'll see more reciprocation from the standpoint of the costs drop dramatically and the cash explodes. So there's a cutoff point when things start to play favorably. It is a long-term effect, not a short-term. And again, it should never be your full retirement plan. It should be part of the total plan. So we think about things like guaranteed income annuities, you have life insurance, retirement plans, you have stock market, alternative investments, stuff like that. It should all play into a portfolio that you can quarterback if you want. You can just do the insurance side and they have a financial advisor. Any way you want to slice it, there's opportunity. But here we're focusing more on the cash value growth versus the death benefit for the betterment of the retirement. Now, if I had the ability to put in, 20K a year for roughly 20 years, I should probably also have some type of term insurance to protect in case I don't make it home tonight to complement on top of the death benefit here. Any questions on this? Does it make sense? People listening, thumbs up if you're listening. Gloria, you're about to say something.
Yes, it makes sense, Phil.
Making sure. I don't mind talking, but it's always nice to hear a sweet voice too.
Now, Phil, I have a question for you.
Yeah.
And with this product, if they go into critical, chronicle, or terminal, they're getting half of whatever the death benefit is up front. Are there other products or other companies where they give you 90% of the death benefit up front?
Well, this one, for example's sake, is 50% of the total death benefit, 2% per month over time for chronic illness. There's no critical with this company. So if you have a heart attack, stroke, or cancer, you're getting nothing. But they also have terminal, which would be that 90% or higher acceleration. So what I use this as an example because sometimes I feel like I just show Corbridge all the time, and I want people to understand that we don't play favorites. There's obviously some lead horses, so to speak, but using a different carrier for example's sake, and I'll show people it's the art of having two options, right? So if I said to you, Gloria, here's Corbridge, QOL, and this is it. And you say, I don't like that. Well, now I got nothing else, so you have a 50-50 shot of success. But if I show two, I say, all right, here's Corebridge. It has chronic critical terminal illness. It has solid accumulation. It has death benefit protection, everything you need. But here's Symetra. So this is Symetra. And Symetra has less living benefits. So you might get more cash value growth potentially because you're not having a drag on those cost of living benefits. So, Mr. and Mrs. Client, what do you value more? And now you have two options that you gave them. So they might pick one of those two options, or they're usually not going to pick the third, which is I don't want anything, but you gave them two options, so you have a higher level of success. The downside is when is too much. So some people, if they do three, four, five options, now the client has to think about it. So you can say, I've run several carriers. These are the top two that I recommend. And now you have a better option of closing that versus showing a ton of illustrations, leading to a ton of questions and them sitting on the fence. So does that make sense?
Phil, I have a question.
Yeah, what's up?
So with Symmetra, you're saying it's a 50% on chronic illness,
Correct.
up to 50%. What's the percentage on Corebridge?
Corbridge is different because they have the situation where it's based on ailment. So, if, for example's sake, I had a heart attack or stroke, it's not dollar for dollar reduction like this would be. It's basically you cash in your policy. So, if, for example's sake, someone has, $1 million policy and they have a heart attack or stroke, they could get a $400,000 payment, and that's it. You cash it in. You can do it on term. You can't do that with Symetra on term. They only have it on their permanent for the chronic illness only, and terminal. So there's no percentages per se, but there's a guaranteed minimum with Corebridge on their policies. So that is going to vary per person, gender, product, face amount, blah, blah, blah. So, but it basically analyzes your life expectancy and gives you a present value for that future death benefit. So there is no percentage per se.
So I'll put it in another way, Phil, the same question.
Yeah.
So from where I transferred my contract, they used to tell or educate agents saying like it's a maximum of 25% for up to max of 25% for chronic and critical.
Yeah, that's
Is
well,
that
that's
true?
incorrect. North American has definition for their living benefits, so that's different. But with AIG, Corebridge, they don't have they have a guaranteed floor, but you can get, and I'll give you a good example. There was a lady who had terminal illness. She had a $50,000 policy, and she accelerated the terminal and they gave her 46 grand. So on the flip side, there was a lady in your prior org who had $1 million term, preferred best in January of 22. By May of 22, she got two forms of breast cancer, and cashed in her policy and got 400K. So that would be a 40% payout for a critical illness claim being invasive cancer. So it's not going to be 25%, but there are carriers that have those percentages. So, kind of playing into the fact if someone likes living benefits more, and I might say Corebridge for I call it a life settlement option. You cash in your policy, or a North American where you have a critical illness, the most you'll get is $50,000 or 25% of the policy, whichever is less. So that's different animal, I'll put it that way.
So, Philip, just expanding on that line of thought, would my assumption be correct that if the client is looking for QOL benefits, then on an overall basis, the Corebridge product would definitely make more sense from QOL?
If they're looking for all the benefits, yes, that would be the conversation.
Okay.
But if for example's sake, they wanted to do max funded policy with no living benefits and say a term policy with living benefits, they could do that too. So if people want to combo them, that's fine. Obviously, Corebridge has that QOL discount too, but I've had several people buy a term from Corebridge and buy an IUL from a different carrier. So it is possible. So,
Okay.
but that's why I say like there's benefits to every carrier, and we could definitely go through that, another time too, on, some of the different benefits, why I pick certain carriers over others. But these are all great questions. So yeah, I appreciate those. But
It's
did that help, Nana?
Yeah, definitely. Because whenever I'm speaking to clients right now, and when I bring up the QOL topic,
Mhm.
they're quite intrigued by it now and the terminology that I use is you don't have to die to benefit from your policy.
Yep. Yep.
And a lot of our clients are finding this as a new concept, which they probably were not aware of or didn't understand in the past.
Yeah. And I think the hard part about Uh, well, your community would be New York Life is riddled with in that community, so it's always whole life, is good. Everything else is bad. There's no living benefits with New York Life. Or you have network marketing, which, in my opinion, doesn't really train to the right way of talking about these type of things. So once again, like you say, there's a bit of a confusion. That's why I always try and tell people when it comes to living benefits, there's some certain things that I would say are pretty important to understand. And if you kind of glaze over it because you're too busy trying to recruit your friends and family, you're only hurting our industry more than helping it, is the best way to put it. So, so yeah, that's again different story for a different day, but when we go through designs, understand that this is a sample or an idea. And there could be several different carriers that might show a better opportunity for this 40-year-old person, comparatively speaking. But I just wanted to not look biased, for once and not show my alma mater, so to speak. So, um,
Just talking about strategy, they quickly flip on what you mentioned. And I've
yeah,
been using the strategy of the term and perm.
yep.
So far, everything I've written is Corebridge.
Mhm.
And I've been able to fly that with the clients where they see the benefits in both.
Yeah, comboing the two. Yeah, I
Yeah.
mean, they have such a great story, and like I said, I don't like to be biased. I mean, I got in 23, I got 11 1099s. So I wrote with several carriers, right? But, you know, they're not the end all be all for everybody. So as you know, one of your clients had tobacco in the system. Now,
Mhm.
had we known he had tobacco in the system and it was cigars, We could get non-tobacco from some other carriers, which would have been better than getting a tobacco rating, right? So,
Correct.
so there's some situations where it's not going to always pan out to be the best. But yeah, they have a very solid package, especially even in the income stages too. So you are right. Couple quick questions popped up in the chat. With this product, they get both death benefit and chronic illness benefits. Why they still need term? So, Roshni, if I was able to put $20,000 a year away into this supplemental policy, again, not the end all be all, probably investing other places as well, would probably mean that if I died tomorrow, $367,111 is not going to be enough for my spouse to get both my kids through college, pay the mortgage, and all the other stuff. So we always want to make sure that we're finding the total need first to protect, and then we start playing around with all the goodies. And Shweta, yes, I do have a cheat sheet that I created for some of what I call the core carriers to understand some differences. So we'll probably go through that one day as well. But great questions. And like I say, don't be afraid to ask the questions, raise your hand, put them in the chat, so that way we can keep it lively and it's not always the monotone man. But so now we'll flip to a different idea. So we talked about LERPs, individual plans. This is more business planning. So a lot of us know business owners in the industry sometimes have an issue with what you would call continuity planning, whether we talk about buy-sell plans, which is typically done with term insurance, but what we always look at is something like key person. So with key person, you have someone in your organization you can't live without. Can't be the business owner because the business owner, it would be a different type of insurance, but I'll explain it through something like this. So let's say a business has someone, a very key employee, right? So the key employee here, what we talk about is taking a business, they put a bonus out there for the employee. So we'll just say, I'll pick on Gloria because that's the first name I saw. Gloria, you're such a great asset to our organization. We want to make sure that we keep you here for at least 10 years. So we're going to give you $20,000 a year. That bonus is paid to the key employee. Now, the key employee does pay taxes because it's going to go in her personal name, but we're going to leverage those premiums inside of a insurance policy to give her cash value that she can use for retirement and or death benefit as well in case she has unexpected passing in, during that time frame. So the biggest thing here is from a business standpoint, what is this business owner doing? He's focusing solely on keeping this key person. So why would he give a bonus out to the key person? Well, again, retention of employee, it attracts top level talent and it helps retain them because you would sign a contract that says, hey, I'll give you this bonus for the next 5 or 10 years. It has to go into this life insurance policy that we're getting for you. You're going to own it. Your kids are going to be the beneficiaries. You can pull money out at any point in time, but it's designed to be a retirement plan. So aside from those intrinsic values that the business gets from retaining the employee, what's the other big thing they get? They're giving a bonus, so they get a wage deduction. So if you have a business owner looking to mitigate taxes and retain their key employees, you can do an executive bonus plan. Now, let's say, for example's sake, we'll use Valor for a second. So you have Danielle and you have Phil as the owners. why would a you know an executive bonus plan not work for us? We're an army of two. Let's say Danielle says to me, "Hey Phil, here's your $20,000 bonus." Why would that not work in this type of strategy?
Because you're the business owner?
Why does that matter? But Roshni, there's two people, Danielle and Phil, so there's 50-50 ownership. So my wife, my wonderful wife, my trophy wife, she gives me a $20,000 bonus. Why does that not matter?
You're
Why,
going to be
Fatima?
Tax.
Yep. Why is there no tax benefit? You're on the right path, Fatima. You want to say it?
Yeah, so I think it's because it's the same family. So when you file the tax, it's coming out from the business, but it's still going,
Yep.
counting as your income.
Yep. So
Exactly.
usually these are pass through entities. So what happens is my wife gives me a bonus. We're gonna pay for it on her personal. So there was no benefit. We're still gonna have to pay tax on it. So yeah. So when you think of S corps or LLCs, those are pass through entities, and there's no tax breaks. Now, if it's a C corp, you can potentially get a tax break, but the cash value then has a fair market value taxation, and so could the death benefit. So really, there's no huge benefit in doing that. You should leave it as a after-tax type of situation. Or in this case, me and my wife owning Valor have a key employee that we're paying a salary. We get bonus them, so we get the tax deduction, but we're not getting any benefit other than employee retention and tax deductions. So I know oftentimes when you have small business owners, this is a huge question that they always get. But once again, going back to and circling back to the actual presentation here, this is how you can use life insurance as an asset class. Now, if you, for example's sake, just kept it at the highest level at the business, we'll say you have Danielle and Phil, but we are two separate people. We're not married in this situation, okay? And let's say we get, $1 million of buy-sell agreement coverage on each of us, okay? But instead of doing term, which a lot of people do, we do permanent. Now, let's say 10 years down the road, we've accumulated, let's say 200K in cash in each of these. That can be part of the assessment for the business. So if we want to sell off the business, you can actually change ownership, give ownership to the new person who will have access to the cash value. Because again, it's ownership driven, it's not insured driven. So those assets are part of the business if you want it to be part of the business. So again, using it as an asset class, it's different to each person, whether you talk personal with the LURP plan or you talk business like this strategy here. These are more unique. If you don't know it, understand that the conversation we're having here today means that someone does know it and we can support. Okay, that's the big thing. This is to give you the idea and understand, and you're probably thinking about clients that can either do the other side or this side, but this is where it's a big deal.
Phil, I
Yeah.
have a question on the previous example, like the example
Yeah.
that you gave about you and your wife,
Yeah.
right? So if the kid, like, if you're talking about the family and the kid becomes major and is not claimed as dependent anymore,
Mhm.
right? Can we use this strategy?
Yes, yes, you can. So as long as they're not part of your tax, as long as they're not part of your tax profile, you don't claim them as a dependent, they're their own independent person. Absolutely.
Got it.
Yep. Yep. So that's a great question. Now, the flip side is the first two cases I talked about are more designed for accumulation, tax-free income, all the touchy-feely stuff on the, benefit for me kind of thing. The flip side is there's leverage in asset conversations in estate planning as well. Okay. So permanent insurance can give you a tax efficient wealth transfer strategy and tax-free legacy for your heirs. So, this is going to be one of the topics that we'll talk about when we have the great collaboration, because I'm going to do full-blown estate planning conversations. So basics all the way to the biggies. But when you think about this, there's estate planning strategies that can help create leverage to grow. Let's talk about real quick a set of grandparents, right? These grandparents, and the way that we would always talk to them when we would work with financial advisors is we would want to address the kids' names. So if I was talking to my parents who are now grandparents and say, Steve, Karen, I understand that you love your grandkids, Cameron and Gavin, sweet kids, right? Oh, yeah, they're the best, this and that. If there was a way where we could show you how you could provide a better legacy to those kids with very minimal risk, I'm sure you'd probably be interested to see or hear about that, wouldn't you? Absolutely. And so then you talk about different strategies. One of the strategies that I will be talking about is the gifting strategy of putting in 18,000 a year per kid into a irrevocable trust, which buys insurance. And if we look at this two couples, there's 65-year-olds, husband and wife, buying a second to die. Now, if there are two grandkids times by 18K, that's 32K times by two people equals 72,000. So 72,000 per year you can gift into a trust, or you can gift to anybody really, and not have any tax implications or a reduction of your lifetime gift exemption. Now, if we look at the example of age 85, clients have invested about $1.4 million into this policy. And they're receiving, well, whoever receives it, $4.1 million. So when we talked about shifting the risk, we talked about shifting the risk for pennies on the dollar. You're still getting roughly, let's say, close to 4-to-1 for your dollar in the second to die plan. Well, most people usually live to around anywhere from about 79 to 82. That's the average age of mortality. This policy, actually in the 0% column, will go all the way to the mid 90s. And if it functions the way it's supposed to, it'll go all the way to 121 at a 6% rate of return. Go ahead, Nana. I saw you on mute.
Philip, did I understand you correctly saying that this gift allowance of 18,000 can be given to anybody and not just your children?
Technically, yes. It should quantify, you have to justify it to the government, but yes, you can technically gift 18,000 to whoever you want.
And they can be of any age?
Once
Very
again, once again, though, think about this. The insurance company has to justify the insurance. Okay. So if I was to gift money to Joe Smith down the street, the thing about this too is there's a thing called crummy letters. It's Crummey. That's the lawyer's last name who created these. So for example's sake, Nana, if you said to me, Phil, I'm going to give you 18,000, but I'm going to put it in this trust for the benefit of my family, the crummy letter has to come to me and it says, hey, Phil, you have 30 days where you can take this money if you want it. Otherwise, it's going into the trust. So when you think about that, if I'm just giving, rando gifts to people, how do you expect them? Well, I'm not getting any benefit out of this, so why wouldn't they take the 18,000? So that's why I say it's probably better if you just focus on the family from that standpoint, because I mean, $72,000 is still a ton of money, and that's for two grandparents for just two grandkids. So there's still a lot of leverage you can do with that.
Just an extension on that question then. When this policy is set up, obviously the children or whoever you're gifting to the money to would become the beneficiaries of the policy, correct?
Well, yeah. So if you had a trust set up, so let's say I was the grantor, I put my money into an ILIT, irrevocable life insurance trust that has insurance in it. The Benny of the policy is my kids or grandkids.
And those beneficiaries be changed, or once you set it up, it's fixed?
Irrevocable.
Irrevocable. Okay, gotcha.
Yep.
Gotcha.
Yep. Great questions, though. So let's see. Roshni asked, what's the end goal for this policy? It's death benefit. Okay. So the idea of the death benefit would be a couple things. I always joke with people and I say, Roshni, do you know your great, 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 great grandfather's name? Probably not.
I wish.
I know, right? You would if they left you some money, right?
Exactly.
So it's all about legacy. So when you think about legacy, you think about that last love letter you're going to give your kids or your grandkids. That's something like this that you can do. Or if they have a tax problem, then you have the need for this type of benefit to pay off the taxes. So think if you have someone who's property rich, they have a lot of properties, and if they pass away, like dealing with a guy right now who unfortunately passed due to cancer, uh, never bought insurance on himself or very little comparatively speaking. But in his last year of living, he was trying very hard to sell some hotels. And after he passed, the whole deal fell through. It was going to be like $30 million of net cash, and it all fell through. So the thing is that if they had life insurance to cover taxation or other concerns, then you don't have to sell properties or other assets that are making money for pennies on the dollar because you have 9 months to pay it off. So if you don't pay it off, then there's a problem. You have to sell stuff in order to, pay Uncle Sam. So everything we do has a purpose, whether to help mitigate or protect someone's livelihood, protect their legacy, and things like that. So good
So,
question came up. Go ahead, Roshni.
yeah, quick question which is connected to what you were saying, Phil. So, are there any limitations or any rules or regulations we need to follow for such kind of policy in place?
Yeah, I mean, you're going to have situations where, and I've had this before, where you would have a kid who's made a ton of money, like the kid is worth a lot of money, and then he wants to put a death benefit on the parents for, we'll just say leverage. And the hard part is that you have to understand that the insurance carriers also know the tricks of the trade and they will put a kibosh on that. So if I had someone living with me, say my in-laws were living with me, though they're living with me for a reason, they might not be able to take care of themselves or whatever financially. Well, if I then said, hey, this person is worth a ton of money, I need a $3 million policy on them, and they're 65, they might say, well, can you financially justify it? Well, if I'm paying for it, that looks like I'm trying to get rich off of someone. The idea is not getting rich, it's getting whole or made whole. So there are some rules per se with the carriers on how much you can invest, or I should say, fund these policies. And if you kind of dive outside of the realm of that, then you're probably not going to get the policy pushed through from the carrier. So when we talk about underwriting, there's a financial underwriting and a physical, underwriting, and you have to pass both of them. So that's why I say if you're dealing with larger cases like this, get someone, if you're not privy to it, get someone who's a specialist and stuff like this to help with that. Because these can be very tough. They can take a while. We had a $35 million case that was a year and a half. And then the guy at the end just said, I don't want it. So it's a year and a half blown because of whatever reason, personal reason he had. But nonetheless, that can happen. These can be very tiring. But if done right, it's a great story. You just have to find the right carrier for it too.
Profil, if you could add in how can we create value proposition in this kind of cases, maybe now or in your next training, anytime.
Yeah, that would be so. I'll leave that as a teaser for the Great Collab because I'm going to talk about estate planning for the Great Collab. And which I saw you registered. Thank you.
Thanks to you.
Oh, I appreciate it. So, yeah, we will have something for more of the wealth transfer conversations. Needs to get in front of people sooner than later for certain reasons. But yeah, there's a lot of meat on the bone for wealth transfer, from that standpoint. So, great question though.
Sure. Thanks, Phil.
Mhm. I saw one in the chat here. Do the grandkids need to pay taxes on this, or is this tax-free going into the trust? So that's a great question, Shweta. The insurance is technically tax-free, okay? But there are rules and parameters in play that say, for example's sake, right now, or let's just say next year, the gifting rules change and the net worth of someone is 14 million. If I have anything higher than that, I'm paying 40% in estate taxes on everything above that. We'll say my net worth for my family and I is 14 million, and then my wife and I pass away. Well, now if this $4 million was inside my personal estate, now I have to pay 40% of this quote unquote tax-free death benefit. So if it's harbored inside of a irrevocable trust, that is a different tax ID. And it also is basically protected against federal estate taxes. So that 4 million is tax-free. Federal estate in inheritance, creditor proof, probate proof. So that's why the affluent tend to put stuff into trusts as opposed to in their name for that very reason. So kind of in closing, there's just different ways that you can lead to conversations, but we have to ultimately figure out the right way to talk about life insurance as an asset class. Is it the death benefit that we're focusing on? Then we shouldn't have too much conversation around the cash value, right? The cash value is a byproduct of what the death benefit focus is. So when you talk to people in the beginning, Mr. and Mrs. Client, do you care more about growth of cash or does death benefit matter more to you? And then you have two different avenues you go. And I would ask them why. Because they'll say, I want both. Why? You can't have this magical product that's going to maximize your death benefit and give you max cash value. It doesn't exist. So we have to figure out what they care about most, and then from that standpoint, dive in from there. So The big thing is education with clients on benefits of the tax favorability of life insurance, the benefits of working with experts like ourselves, regular policy reviews. So if you have any cash value policies, you'll want to make sure that you're doing those consistently, like every year. And then working with tax professionals, CPAs, attorneys, those are good lead sources too. So if you know any CPAs, they can be a great source of having conversations like this to deliver to their clients, and you can partner up. And long-term relationships, the goal is always to develop these long-term relationships. So last but not least, we have the takeaways. Once again, cash value life insurance or permanent insurance can offer a tax advantage asset, but we have to understand the benefits. If you don't understand the benefits, get someone on your team that does and partner up and learn from them. And I always have accessibility, so you can book time on my calendar and we can dive in together to make sure you're getting what you need for your customer. The big thing is that you've got help, you've got support. That's the reason why I'm here today, and I'm going to be here every Wednesday night for, basic training, Thursday for this type of sales training and stuff like that. And everything to just kind of continue to enhance the value proposition. So, what I'll do is I'll leave this up. Now, for those of you who have my other 860 phone number, this is not my normal cell. This is my marketing cell number. It does come to my phone too, but if you have the 402-8262, that's my actual number. If you have other questions, you want to email me, phil@valorfs.com. I will give you a moment in case you have additional questions. Gloria, you came off mute.
No, that's why I'm saying, and this is why this is so important that you guys all register to go to the great collaboration in Dallas, because these are the nuggets you're going to get. I could tell you from experience, last year I went and I got so many nuggets from there because we collaborate. Agents that are on the bottom compete, but we agents that are at the top, we collaborate. And there's so much going around. And this is why we partnered with Valor, because this is the training you're not going to get anywhere else. So if you haven't made that decision yet, listen, you're missing the boat. And I just would recommend make that decision, partner with Valor, partner with the regular partners in your area that are going to be there to help you every step of the way of building your business.
No, I appreciate
and he didn't pay me to say that, by the way, guys.
I know. I'm like, oh. So, and just to give you an idea, some of the speaking events and things like that. So I'll be talking about estate planning at 1:00 on the first day, May 3rd. So I'll also be talking about building an independent agency. So if you want to be field facing, in your industry, understand that there's certain things like I see, Prasanna, he's got his IRA, solutions as his little logo there. I've got mine when I go off camera, I got the Valor logo. So if you're not personally branding yourself, I'm not gonna lie, Gmail accounts, if someone sends me a Gmail account, I usually don't look at it as much as I would look at, Phil@ValorFS. So those will be some of the things we talk about and how to build your brand. Partnering with RIAs, I'll have a RIA there to talk about partnership and how you guys can collaborate together. Different carriers, different tech. So Insight helps with running illustrations. So we'll have a lot of cool stuff. It's not designed to be a rah-rah, you have to work at Valor kind of thing. So there's literally 7 different, partners who are sponsoring this event. So, or 8, excuse me. So that being said, the hyperlink was I put it in the top. Some people put some chat action in. It's all the way at the top if you want to register. Do it now before the 1st. So want to say thank you guys. Appreciate it. So again, Wednesday nights, 3 o'clock. Thursdays, or excuse me, 8 p.m. Central. Thursdays, 4 p.m. Central. And we'll continue doing these.
Thank you so much, Philip. Really appreciate you as always.
All right. You guys have a great rest of your day. And if
Thank
we
you,
don't talk,
Phil.
have a great weekend.
Thank you so much, Phil.
See you guys.